welcome to another session on capital structure. In previous session we have discussed net income approach, and now in this section we will continue with net operating income approach or net operating income theory. So, according to this theory, the total market value of the firm, that is V, is not affected by change in the capital structure, and the overall cost of capital remains fixed irrespective of debt equity ratio. So, this theory says that whatever the debt equity ratio, it is not going to impact the value of the firm. Okay. Like any other theory, this theory also have certain assumptions. So, the first one is the split of total capitalization between debt and equity is not essential or relevant. As I mentioned in my previous session, this falls under the category of irrelevant theory of capital structure. And this theory also states that capital structure is not going to impact the value of the firm. Another assumption is the equity shareholders and other investors, that is the market capitalizes the value of the firm as the whole, right. The business risk at each level of the debt equity remains constant. Therefore, the overall cost of capital also remain constant. KD and KE, that is cost of debt and cost of equity, will also remain constant, and corporate income tax does not exist. Okay. Moving ahead with the practical part of this theory, and this theory is represented with the help of this equation where our value of the firm is equal to, this is similar to what we have discussed in the previous theory, where valuation of firm V is equal to EBIT divided by overall cost of capital. And when we need to calculate the value of firm using value of equity and debt, then value of firm is equal to E plus D, that is equity and debt, and we can interchange the values for calculating the missing figures. And overall cost of capital can also be calculated by subtracting interest from EBIT and dividing the remaining amount by E. Okay. Now, this approach says that according to net operating income approach, KO remains constant, therefore, there is no optimal capital structure, because every capital structure is same. Whatever capital structure you are going to have, whatever ratio of debt and equity you are going to have, it is not going to impact the value of the firm. Rather, every capital structure is as good as any other. So, every capital structure is the optimal one according to NOI approach. Now, let us try and understand NOI approach with the help of one example. A firm has an EBIT of rupees 2 lakh and belongs to the risk class of 10%. Now, what is the value of cost of equity capital if it employs 6% debt to the extent of 30%, 40% and 50% of total capital fund of 10 lakh. So, the total capital fund this company has is 10 lakh. Now, we have three cases on the basis of which we need to analyze this approach, like we have done in net income approach. In net income approach also we have used three different cases where the debt was 5 lakh, then debt was increased to 7 lakh and then debt was decreased to 2 lakh. In this case also we will change the proportion of debt from 30% to 40% and then to 50%, and we will see whether the value of firm will change or not. Now, let us take the first case where the debt is 30%, EBIT is given, that is 2 lakh, overall cost of capital is also given as 10%. Based on this, we will calculate value of the firm, where value of the firm is equal to EBIT divided by KO, that is 20 lakh. We have divided 2 lakh by 10%. Debt is 30% of the capital. Capital was 10 lakh, so the debt amount is 3 lakh. Now, if D, value of debt is 3 lakh, overall value of firm is 20 lakh, E, that is value of equity, will become 20 lakh minus 3 lakh, that is 17 lakh. In this case, our net profit will become EBIT minus interest, that means 2 lakh minus 18%, that is 1,82,000. Now, our KE, cost of equity, will become 1,82,000 because this is the net profit available for our equity shareholders, divided by value of equity, 1,82,000 divided by 17 lakh. So, our KE will become 10.71%. Okay, now we have cost of debt with us, we have cost of equity with us. Okay, you remember or you may refer to the previous sessions when we have discussed weighted average cost of capital. This was the equation we have discussed in that session. Now, bringing that equation from that session here, our WACC is equal to cost of debt multiplied by proportion of debt in this capital structure plus cost of equity multiplied by proportion of equity in this capital structure. We will placing the number values in this particular equation. So, in our case, our D debt or value of debt is 3 lakh divided by overall capital structure or amount of capital in our capital structure, that is 3 lakh plus 17 lakh 20 lakh multiplied by cost of debt, which is 6%, it was given in the question, plus 17 lakh, it is the ratio of debt, divided by 20 lakh, again overall value, multiplied by 10.71%. This is the cost of equity that we have just now calculated. Now, by solving this equation, we will get our overall cost of capital, that is WACC, which is 10%. Then we have our second case where our debt is 40%. So, earlier our debt was 30%, that is 3 lakh. Now, our debt is 40%, that is 4 lakh. EBIT is same 2 lakh, overall cost of capital is 10%. Value is 20 lakh, value of firm is 20 lakh. Now, now the value of debt is 4 lakh. Now, value of equity is equal to 20 lakh minus 4 lakh, which is 16 lakh. Net profit, the equation will remain same, EBIT minus interest. Our EBIT is 2 lakh minus interest, that is 24,000, that is 4 lakh multiplied by 6%, because 4 lakh is raised at the rate of 6%. So, 2 lakh minus 24,000, that is 1,76,000, this is our net profit. We will divide our net profit by value of equity so that we can have cost of equity. So, 1,76,000 divided by 16 lakh, we get the value as 11%. This is our cost of equity. Now, placing the value in the same equation, we will calculate WACC. So, here our debt is 4 lakh divided by our overall capital structure, that is 20 lakh multiplied by rate of debt, that is 6%, plus 16 lakh, that is our value of equity, divided by debt plus equity, that is 20 lakh multiplied by 11%, that is our cost of equity that we have just now calculated. By solving this equation, we will get WACC, that is 10%. It is equal to the value of overall cost of capital that we have calculated in the previous part when the debt was 30%, that is 3 lakh. Let us also see the third case when the debt is increased further and now the debt is 50%. Now, when the debt is 50%, the value of debt D will become 5 lakh, everything will remain same. Cost of equity will change to 15 lakh. Our net profit will become 2 lakh, EBIT minus 30 lakh, 30 lakh is 6% of 5 lakh, right. So, our net profit will become 1,70,000. Our cost of equity will become 1,70,000 divided by 15 lakh, because here our E was 15 lakh, our cost of equity here will come to 11.33%. Now, placing the values in the same equation, we will solve this equation and again we will get the same value, that is WACC is equal to 10%, right. So, we have seen 3 cases, we have changed the value or proportion of debt in our capital structure, the overall capital structure will remain same in all the 3 cases, that is 20 lakh, 20 lakh, 20 lakh, but our overall cost of capital remains same, it is not changing at all, even though the proportion is keep on changing in all the 3 cases. So, this is the conclusion of net operating income, which says that whatever the ratio of debt and equity in your capital structure, it is irrelevant to overall cost of capital or value of firm, it will remain same. Okay. So, this is all about net operating approach or net operating income theory. The third theory that we have is traditional theory. Now, according to traditional theory, a firm can reduce overall cost of capital or increase the value of firm by increasing debt proportion in its capital structure, but up to a certain limit. Now, it is a combination of previous two theories. First theory says that debt, keep on increasing debt, it will keep on increasing your value of firm. Second theory says that whatever the ratio of debt in your capital structure, it is not going to impact your value of firm. The third theory, that is traditional theory, says that it impacts, the proportion of debt impacts, but it impacts only up to a certain limit, but not beyond that. Okay. So, there are three stages. This theory is classified into three stages. The first stage says that the use of debt in capital structure increases the value of the firm and decreases cost of equity. The second stage says that there is a range in which value of the firm will be maximum and cost of capital, overall cost of capital will be minimum. And then we have the third stage, which this is the stage when the value of firm started decreasing, even though you are increasing the proportion of debt in your capital structure. So, this stage states that the V will decrease and the KO will increase in this stage. So, these are the three stages of traditional approach. We will use the same equations for verify to testify this theory as well with the help of one practical example. So, example is there on the screen, it is a long example. So, A Limited having EBIT of rupees 1,50,000 is contemplating to redeem a part of the capital by introducing debt financing. Presently, it is 100% equity firm with the equity capitalization rate of 16%. That means our KE is 16%. The firm is to redeem the capital by introducing debt financing up to 3 lakh, that is 30% of total funds, or up to 5 lakh, that is 50% of total funds. So, there are two options that this firm is considering, either 3 lakh or 5 lakh. It is expected that for debt financing up to 30 lakh, the rate of interest will be 10%. So, if they are opting for the first option, that is 3 lakh, the rate of interest will be 10% and KE will increase to 17% in first case. However, if the firm opts for 50% that debt financing, that is up to 5 lakh rupees, then the interest will be payable at the rate of 12% and KE will become 20%. Now, we need to find out the value of the firm and WACC under different levels of debt financing. Let us solve this question one by one. Okay, using this table, I can demonstrate and we may understand that how traditional theory works. So, first column shows the particulars and then there are three cases that we are going to consider. First case, when there is no debt, this is the present situation. 30% debt is the second case or the first case which the company want to opt for. And another case is 50% debt, that is the case of 5 lakh debt. This is the second option that the company wants to consider. Now, these are the three situations that we are going to compare. So, total debt in first case is 0, but in second case it is 3 lakh and in third case it is 5 lakh. Rate of interest, since there is no debt in first case, the rate of interest will become 0, but if the company is opting 30% debt, the rate of interest will be 10%, and if company is opting for 50% debt, the rate of interest will become 12%. EBIT is same in all the three cases, that is 1,50,000. Now, interest in case 1 will be 0 since there is no debt. In second case, it is 10% of our debt, that is 10% of 3 lakh 30,000, and in third case, it will be 12% of 5 lakh, that is 60,000. Our EBT or net profit or earning before tax will come to 1,50,000 in case 1, 1,20,000 in case 2 and 90,000 in case 3. Okay. Taking EBT further, our KE is 16% at present or in case 1, 17% if the company is opting for 30% debt, 20% if the company is opting for 50% debt. So, using this we may calculate our E, value of equity, that is EBT divided by KE. So, in case 1 it is 9,37,500, in second case it is 7,05,882 and in third case it is 4,50,000. Our value of firm, we already have the value of debt. By adding value of equity and value of debt, we will get the value of firm. So, in first case, since there is no debt, the value of firm is equal to value of equity only. is 9,37,500. In second case, since the debt is 3 lakh, value of equity is 7,05,882, our value of firm will become 10,05,882. In third case, our debt is 5 lakh, our equity value is 4,50,000, our overall value of firm will become 9,50,000. Now, using these values, we will calculate overall cost of capital, that is 16% in case 1, 14.9% in case 2 and 15.8% in case 3. Now, this table clarifies that when we are increasing debt, in first case we have no debt, but when we are increasing debt from no debt to 3 lakh, we are able to reduce overall cost of capital and we are able to increase the value of firm. Okay. But when we are increasing the debt further from 3 lakh to 5 lakh, we are not able to match the previous situation, because in this case our overall cost of capital is increasing and it has reached to 15.8%, while our value of firm is decreasing, that is 9,50,000. So, this justifies our traditional theory that increasing the proportion of debt in our capital structure impacts the value of the firm and overall cost of capital. It reduces, but up to a certain extent only. It impacts only up to a certain extent. Beyond that, it stops impacting, rather it started impacting negatively on our capital structure. Now, the last one that we have is our Modigliani-Miller approach. This is the extension of net operating approach. It is a relationship between leverage, cost of capital and value of the firm. Now, under the given assumptions, the capital structure and its composition have no effect on value of the firm. This is what this approach or Modigliani-Miller approach says. So, there is nothing which may be called as optimal capital structure. So, that is why it falls under that category of irrelevant theories of capital structure, because it also says that there is nothing which may be called as optimal capital structure. So, whatever capital structure we have is the optimal capital structure for us. So, this theory also works on certain assumptions. It says that capital markets are perfect in nature, securities that we are buying or selling are infinitely divisible, investors are rational and well informed, all investors have the same probability distribution about expected future earnings. So, the information is available to all the investors equally. There is no corporate tax. Personal leverage and corporate leverage are the perfect substitutes of each other. Okay, whether you are raising funds from corporates or you are putting your own fund in the capital structure as debt, the value will remain equal. So, this approach says that if two firms which are alike in all respects except that they differ in their financial or financing pattern and their market value, the investors have a tendency to sell the shares of overvalued firm and to buy the shares of undervalued firm. So, investors will sell the shares of overvalued firm, they will buy the shares of undervalued firm, and this buying and selling pressure will continue till the two firms will have the same market value. That is why as per approach, there is no capital structure which is optimal in nature, and all capital structures are optimal, because this will keep on happening. Okay. When the investor will move to the undervalued firm, the value of this firm will start increasing, and now this will become an overvalued firm, and the firm from which the amount was withdrawn, it will become undervalued. Now, the time will come when the investors will start reversing their investments, and the same cycle will go on. So, that is why this approach says that there is no optimal or a perfect capital structure. Okay. So, these were the four theories, four models of capital structures that we have discussed today. So, let us conclude today's session here. So, as we come to the end of today's session on capital structure, let us briefly recap the key points that we have discussed today. We have explored how a company's financing mix means our mix of debt and equity, impacts its overall performance, the cost of capital and the financial risk of the company. Okay. We have discussed the importance of balancing these two sources of funding to optimize the company's value. How we can optimize the company's value by balancing these two sources. Two sources stands for debt and equity, two major sources of funding, two major sources of finance. We have also examined the key theories of capital structure. We have discussed 4 theories of capital structure, that is net income theory, net operating income theory, traditional theory and approach. These theories are categorized as relevant and irrelevant theories of capital structure, or relevance or irrelevance theories of capital structures. Where net income theory and traditional theories, these are categorized as relevance theory of capital structure, while net operating income theory and approach or Modigliani-Miller theory, these are categorized as irrelevance theories of capital structure. Because net income theory and traditional theory, these two theories says that the change in capital structure or the proportion in which we are having debt and equity in our capital structure, it is going to impact the value of the firm. It is going to impact the overall cost of capital of the firm. On the other hand, net operating income theory and approach or theory says that whatever the proportion of debt and equity you are having in your capital structure, it is irrelevant to valuation of the firm, because you may increase or decrease the proportion of debt in your capital structure. The value of firm and overall cost of capital will remain same. It is not going to change. We have examined these theories with the help of practical examples as well. We have used numerical values. We have substituted these values in the equations which are given by these theories. We have verified these theories with the help of these practical examples, and we have proved it that how net income theory and traditional theory fall under category of relevance theories, while net operating income theory and theory falls under the category of irrelevance theories of capital structure. Dear learners, remember, the goal of capital structure management is to strike a balance that supports the company's growth objective while minimizing risk and maximizing shareholders' value. Okay. This was the primary objective of financial management. This is from where we have initiated our first lecture or first session of financial management. I therefore encourage you all to think about these principles. Apply these principles to the real world companies, because these are practically applicable in the companies. Okay. Thank you for your attention for today. I look forward to our next session where we will continue to deepen our understanding of financial management. Till then, happy learning.